What's going on, guys? Welcome back to the channel. My name is Leo, and today we're doing a stock analysis on Microsoft. If you're new to the channel, I like using my stock research app. That is an app that helps me research companies more effectively. More on that a little bit later on. So we have Microsoft pulled up, and we're going to run through the numbers of this business and see what it's all about. This company has been on a downward trend, as we can currently see here, from October 2021 now to October 2022. The 52-week range of this company was at $350 and a low of $219. We're in that 52-week range, folks, with this business. Now, when I see companies on a massive decline, I ask myself two questions. Well, what is causing this massive decline in stock price, rather, and how can I capitalize on this? Because when I see a company go down in price, folks, it doesn't mean that the company's worth less. It's now the perception has changed. Now, is that from a fundamental perspective, or is that from a perspective of just being complete speculation? Because here's the thing, with Microsoft, we are ranking this company a 9 out of 10. Now, what does that mean here, folks, with its financial valuations? Well, this section here takes a look at the company's financial statements, the cash flow statements, the balance sheets, income statements, and then I have 10 specific criteria points where they have to meet. And if they meet those points, they get a point. So in the case of Microsoft, the only thing they are doing wrong, in my eyes, is that they have a high PE ratio on average. We want to see this number, which is currently at 35, is a pretty high multiple. We want it to be below 22.5. In our trailing 12 months, in this section here, which we can use to cross-reference with the financial valuations, we can see from a comparative standpoint, even though our average is 35.09, currently it's at 23.49, right? So we have a decrease in PE ratio, so that is exciting to see, and we will go through this section afterwards, but you can instantly see that our EPS is higher than our 5-year average. There's higher ROE, so even though our earnings multiple is lower, everything else in this company has been improving. So back to the financial valuations, to this lovely section here. The 9 out of 10. What are those 9 categories and what are they doing right? The current ratio. The current ratio essentially means that the company has enough assets on hand to cover their liabilities. This is important in the case of, let's say, an upcoming recession, which we are pretty much on the cusp of. We are heading into those not uncharted waters per se, but where things are likely to get shaky. We want a company that has enough assets on hand to cover those liabilities in case of a terrible scenario. So Microsoft has that. They have an extremely high return on equity average, sitting at 36. Their EPS growth has gone up by 870% over the last 5 years. So as a shareholder, this is super important that even though you're holding on to this company, the amount of earnings this company has been bringing in is also increasing as well. And that's evident here, folks. So you look at the revenue growth, it's up 17%. They have a low debt to equity ratio, which is super important because we want to make sure that they're leveraging their capital from an equity perspective, not taking on debt. Ideally, you want to have there's a balance that you want. Ideally, you want to be around underneath 50%. That I feel is the smart ballpark. So they're sitting at 35%. That's pretty good. They've decreased the amount of shares outstanding, their net income is growing, their free cash flow is growing, and they have a healthy return on invested capital. This company knows how to make money. It's Microsoft, right? This is a staple. This is a blue chip company at the end of the day with a lot of room to grow as we eventually embark onto new technological fronts with the Xbox platform and other things to come with Windows. They are just getting started. I can't say just getting started, but the Xbox platform has been a huge venture for them as they're looking to potentially buy, I don't know if it's going to go through or not, but Activision. They already purchased Bethesda, looking to buy Activision. These are one of the top video game publishing companies ever. So their content library is huge, and video game industry as a whole has been growing exponential amounts. The foreseeable future that I can see is with esports becoming a major player in the game, and I think Microsoft realizes that. That is why they're getting in early. publishers like Activision making games like Call of Duty, which is a highly competitive first-person shooting game, that is going to be probably one of the forefront games, possibly in the future, for this whole esports debacle, essentially. But what do I think about Microsoft? I think it's a phenomenal business, and honestly, I'm looking to own this business. I'm looking to own this company. The only thing that's holding me back is the price. So what we're going to do, folks, is we're going to figure out what is this company actually worth. I've analyzed this company a few times, but I've used different evaluation metrics, and I'm going to put these metrics here in the price analysis section here, and I'll fill out these lovely boxes and I'll tell you what I did. But what we're going to do is do a 10-year analysis. We're going to do 3 different assumptions using our historic numbers that we have to our right as a ballpark. So I'll fill those out and I'll get back to you in just a quick second, so stand by. So folks, if you've been enjoying this video so far, make sure you hit that like button and subscribe button. This software that I have in front of me, you can access it at leodeleo.com. The link is in the description box below. Sign up on the site. It's completely free. It gives you access to the Discord server filled with other investors and other like-minded people that want to improve their investing process, as well as you can talk to me one-on-one and we can talk stocks, talk whatever you like. But this software here, there's a 7-day free trial where you can access this amazing piece of software, and we're only scratching the surface with this software here, and I'll show you this neat little feature that you probably want, and that's the price analysis section, which gives you the intrinsic value of any company. With Microsoft, what I did here, folks, if you're new to the channel, I try to stay as conservative as possible with my assumptions. So I've done a discount on my revenue growth numbers, where what I think how the company is going to grow over the next 10 years. So I put those revenue growth numbers in, and with my profit margin and free cash flow margins, I look towards my historic numbers here. So currently, on average, it was a 30% profit margin compared to 10 years ago, 26. So I'm going to stick on the low end and do 22, 23, 24. Let's assume that they lose some, they're not making as much money because we're going into a recession, right? So the next 10 years may be a little bit rocky for Microsoft. So I did 22, 23, 24 because the last few years have been phenomenal. So let's assume the years are not that great. Free cash flow margin, I'm sticking with in my 30 range because even though the profit hasn't been going up, it hasn't been so great, I'm gonna keep the free cash flow margin the same to keep it relative. Now with the price to free cash flow and PE ratio, I did a conservative estimate by being 14, 16, and 18. Ideally, folks, as I said with the PE ratio, we want to be underneath 22.5. That's the same rule that applies to price to free cash flow. Now, granted, you could put this multiple at any price point that you want, but I feel to pay for a price point that's below 20 makes the most amount of sense. 14 to 20, I find that is the sweet zone. Anything lower, hey, that is an extreme value territory, but anywhere between 14 and 20, I find that the company still has enough free cash flow on hand and there's room to grow. And that same thing goes with the PE ratio. 14 to 22.5 is a safe zone. Anything above that, you might be in a higher premium for. And given the market cap of Microsoft, that doesn't make sense to me, at least. So I click, put in 13% return. I'm going to click calculate. Now this software, folks, is going to run through all of these different assumptions and all these numbers and spit out a price of what Microsoft should be worth. So the current price right now at the time of recording this video is $228.56. Average calculation, folks, comes out to $276.42. That is phenomenal. So what does that scream out to me, folks? That screams that Microsoft is in undervalued territory. But where do I think it lies? I personally think that on the conservative side of things, it might be over here between conservative and moderate. So moderate average is 27 and low side is 196. Quite a large jump from 10 to 12% revenue growth. So what does that mean? I think it might be, this 230 range might be the fair value to pay. And this goes on the assumption that if you pay, let's say $271 for one share, you could assume a 13% return over the next 10 years. Now, if this price point goes below, I might just actually pick up Microsoft at this price. I feel like this might be the ticket in. Let's say if I do 11% revenue growth, or rather if I do 10.5, right, and change this to 11, how does that alter our calculations? We'll see. This is where, when I have green on the board, take a look at that. Moderate average, that's 236. So yeah, we're in this sweet zone. Conservative and moderate average. I would love this to be green. But 235 on average, if you pay 235 for this company, and I'm not changing the revenue growth numbers by a considerable amount, literally 0.5, literally a percentage apart from our conservative to aggressive, this might be a value stock. This might be something for myself to pick up. I am going to put that definitely on the watch list. I want to see if I can get this at a lower price, but I might just dollar cost average down and just pick up Microsoft right now. But yeah, folks, if you want to follow me more and not just the videos, head over to leodeleo.com and get access to the Discord server. I post, well, we just opened up the server, but I'm going to be posting all of my watch list stocks for things that I'm waiting to be undervalued and things I'm potentially going to be picking up. But it's just a social space for like-minded people that want to improve their investing game. I want the software and community to be pretty much one of the same, so we can all work together and pretty much conquer this market. It's been overpriced for too long, so now it's time for us value investors to take back our companies at fair valuations, folks. That's the revolution that's happening. If you enjoy this video, hit that like button, subscribe button, and if you want to see a company analyzed, write it down in the comment section below, or better yet, head over to the website, get this software, 7-day free trial, and I'll show you what we got here, folks. Along with the stock spec page, we have the balance sheets, the income statements, all this lovely tools. We have for 10 years of data on every single company in the US, Canada, Euronext markets. So that's income statement, cash flow statements, as well as the balance sheets, as well as we have charts if you want to see everything more visually. This is a phenomenal tool that's used by many to analyze companies more effectively. So get it today, sign up right now, follow the link, and I'll stop talking. Thank you so much for watching, guys. I'll see you in the next one.